right, you're welcome to our channel. This is Nedi, your forex coach, and today I would like to do an introduction to the market makers trading strategy. A lot of people call it beat the market makers, but this is really the market cycles, the forex market cycles, which every forex trader need to understand and follow. It is a structure, and this has been seen to be consistent over a period of time historically. So following this structure and also knowing the underlying principles and reasons why the market run through this structure will help you in improving your profitability. All right, so let's go right into it. Here, the market has four phases, four cycles. All right, it has four cycles beginning from the accumulation phase. Then the next is the inducement phase. The trapping phase is the fourth phase, and then the final phase is the run phase. And this happens over and over in different currency pairs. You see, it doesn't matter the currency pair, whether you're trading instruments, whether you're trading gold, whatever it is, follows this same cycle. But it is very important that you understand how to identify it in your charts. Identify it in the charts. You can use the 1 hour time frame for this. To identify these cycles. 1 hour time frame is very ideal for this, and you take your trades using the 15 minutes time frame. I'm just going to run you through the cycles, and then in another video I'm going to show you some of the things that you need to do, things you need to put in place to take advantage of the immense trading opportunities that come out from these particular strategy. All right, so straight is the accumulation phase. This is where the dealers, the market makers, begin to accumulate orders, and this usually happens during the Asian section. All right, depending on your location in the world. Okay, for those in Africa, it's usually in their night time, maybe beginning from 10 p.m. Down to maybe 6 a.m. in the morning. The markets, the London section and the New York section has closed. Okay, and in this phase, you usually have low movements in the markets. All right, the volatility is very low, so you find market trading between support zone and resistance zone. It just moves up and down without a direction. All right, the moment it's the beginning of the London section, okay, maybe in Lagos, Nigeria, this should be around 8 a.m. You'll find out that the market breaks up. There must be a breakout either on the upside or on the downside. Which one of them? In the drawing up here, this is a breakout in the upside, and then drawing down here, this is a breakout on the downside. It really does not matter where the breakout is going. You don't really care whether it's going to break out on the upside or it's going to break out on the low side. You are just monitoring the movement. So you're just monitoring the movement. Once there's a breakout, market usually has like 3 pushes. You can see it here. 1, 2, 3. All right. In the P&L wave counting, it will be 5 waves: 1, 2, 3, 4, and 5. And in some cases, these 5 waves are not very visible. It's important that you understand the phase, the market environment that you are in. So we are counting. This happens in the Asian session. That's accumulation phase happens in the Asian session. Then the inducement happens at the opening of the London section. Market will be seen to push 3 times up or down. There's a breakout, all right? And this happens, maybe between 20 to 50 pips thereabout on your 1 hour time frame. Then the next phase is the trapping phase. All right, at this point is game over for the buyers. Everybody was okay. Market has been, accumulating, it's been ranging between support and resistance zones. Now there is a breakout. Let's enter. Yeah, the breakout rule says buy or sell in the direction of the price breakout. Fine. But now a lot of people will take orders here, and at this point, and a lot of orders will be taken is all inducement. What the market makers actually, that's a big institution. Okay, their objective is to deceive you, is to induce you, to make you see some, market moves that will entice you to take a trade in that direction. You see, but for that day, that is not the direction that the market will go. It's all about deception. So that's why it's called inducement. They will induce you by seeing some breakout in the direction. Then you think, oh, price is going to go in this direction. I want to, maybe trade a position and stay there to the end of the day or even to the next day. But no, they will get you at this trapping phase. And at this trapping phase, you see different market structures here, different structures. Some of them will look like an M or double top. Some of them will look like head, shoulder, and shoulder, head, and shoulder. I'm going to show you on that slide. All right. And sometimes it can be a triple top. Whatever it is that is a reversal pattern, that one reversal pattern must show at this phase, the trapping phase, which says game over for the buyers. And suddenly you're going to see price come down, break this level of support and begin to come down, massively. And this can happen anytime between 10 a.m. and 11 a.m. But it can also happen some other time before the before the New York session. All right, before the New York session, the inducement phase happens at the opening of the London section, and then this will lead us to the trapping phase. And the trapping phase is marked by some reversal, patterns like double top, which looks like an M, or triple top. It can be, shoulder, head, and shoulder. It can be a rounding top. Whatever it is that shows here, all right, and then the details. I told you that in another video I'm going to teach on how you can trade this market cycle and make huge sums of money on daily and weekly basis. All right, so here is bye-bye to the buyers. All right, and price enters into the final phase, which is the run phase. It is game over. Market can move from this point, from the trapping phase into the run phase, can give you up to 100 pips, 150 pips, depending on that daily volatility. All right, so the same thing happens here. Okay, this is just the opposite of what happened there. In the upper one, you can see there is the breakout in the upside, but this one is a breakout on the downside. And market makes these three pushes downwards and now give you a reversal pattern, which is what marks the trapping phase. All right, from the trapping phase, price will immediately run. Price will immediately run in the opposite direction, the direction that is opposite to where it started from. So price will move from this point and can give you as much as 120 pips, 150 pips, depending on the daily volatility. The inducement phase is usually between 20 and 50 pips, sometimes 40 pips. All right, it's very risky to trade the inducement phase. But as a trader, your duty is to understand the cycles, begin to learn to identify them in the market, understand where the trapping phase is. The trapping phase is actually where we look for entries to either buy or sell, depending on what is happening in the market. Now, let me do a practical example of this here. All right, I want to do a drawing here. All right, so this actually is, if you look at here, if you look at these points, all right, if you look at this place, I want to just draw it again. Now, this is the accumulation phase. Price is seen to move between these two ranges and now breaks out into, it moves 3 times up, all right, and now enters into this trapping phase. So this is the inducement phase. This is the accumulation phase. All right, and I said accumulation phase happens around the Asian section, and now here is the trapping phase. Here is the trapping phase. So when you see this happen, you draw a line here up and down, giving you the resistance and the support. A breakout on this downside will give you an opportunity to sell, and this is what you see happen. Price will move sometimes below or just hit this same level of support. Usually this level of support will give you your first take profit depending on the volatility of the day. So we have the accumulation phase. Here is the run phase. The last phase, the run phase, that's where you expected to be in the market in the run phase. This is where you're expecting to be. You are monitoring the accumulation phase, inducement phase, trapping phase, your entries around this area, and move all the way down, till your take profit is hit. Thank you so much for watching this video. If you like, we'd like you to click that like button and also subscribe so that we'll have our videos each time that it is released. If you have any queries, you can drop questions or make inquiries, on the discussion button down on our channel. Thank you so much for watching. I'm going to see you again in the next video.